Hello, my name is Elliott. I'm the editor of the Energy Strategist, a twice-monthly publication focused on covering the energy markets, the global energy markets. I want to talk a little bit today about probably one of the issues that's been most on the front pages over the last several months, which is the price of oil. As if everyone is well aware, oil prices have approached and almost touched $100 a barrel on several occasions over the past month. And I think there's been a lot of misinformation out there as to exactly why that's been happening. Typically what's reported in the news is that it has something to do with geopolitics or future speculation or any number of very convenient explanations that have been brought up over the last several years. But the reality is I think that it's been due mainly to very tight supply and relatively strong demand. We just haven't seen much demand destruction due to those higher oil prices. And at the same time, inventories globally for oil and oil-related products like gasoline have been tightening over the past 6 months or so. Normally, in the third and the fourth quarter, you'll actually see those inventories build. We just haven't been seeing that this year. So inventories globally have been a lot tighter than normal. In particular, for example, in Japan, inventories of oil are at about 20-year lows. So I think that's the supply side of the equation. The demand remaining very strong, we've seen oil prices gradually drift higher. One of the reasons we haven't seen inventories build, of course, has to do with OPEC. Non-OPEC production of oil has been very disappointing this year compared to expectations earlier in the year. We've seen a lot of project delays, some political problems in places like Nigeria, the disrupted supply. And OPEC, for its part, just hasn't been shipping oil to the United States and Europe and other countries as it would normally do in this time of the year. The easiest way to determine that is to actually look at tanker rates. Tanker rates are simply the rates that are charged by tanker companies to haul oil. They're a daily rate or a day rate. And there are several indices of these out there. The most common ones are the Baltic indices, the Baltic exchange indices. And what we saw is that tanker rates typically spike going into the fourth quarter of the year. The reason is that's the time of year when tankers are in very, very high demand to take oil from the Middle East, places like Saudi Arabia, and ship it to the United States. So tankers are in very high demand because OPEC wants to ship crude oil to the United States in time for the refiners to start refining ahead of the next year's summer driving season. We hadn't seen that at all this year. Tanker rates have remained very depressed going into the early days of the fourth quarter because OPEC simply wasn't moving oil to the West. But now we've seen a total change in that trend. And what I do think you will see, it's very difficult to pinpoint an exact timing for it, but what I do think you will see over the next few months is a significant pullback in oil prices. Depending upon the degree of the economic slowdown globally, oil prices could easily go back into the 70s. Or perhaps even a bit lower. It certainly won't end the longer-term bull market in oil. I do eventually expect to see oil prices well over 100. But over the next 3 or 4 months, I do think that'll be challenged. And again, the main reason I'm seeing that is we've seen oil tanker rates actually spike over the last couple of weeks. They've actually doubled over the last few weeks. The reason for that is that OPEC countries are finally starting to move oil west to places like the United States. Eventually that will show up in oil inventories in the West and that'll begin to take some pressure off supply. Just a couple of ideas on how you might go about playing that. The first place I would look for a shorter term move would be the tanker stocks. These companies are highly cyclical, but companies with a lot of exposure to the spot tanker market will tend to benefit from those higher tanker rates. One company that I would mention would be Frontline. Symbol is FRO. Longer term, I do think that the pullback in oil prices will have an impact on oil services stocks, oil drilling stocks, as well as, of course, the producers themselves. I do think that pullback will prove to be a buying opportunity. However, over the next 3 or 4 months, it's probably a good idea to take on a few hedges. I would look specifically at companies with exposure to the North American market, which has been very weak over the last couple of years. Companies like Halliburton, for example, symbol HAL. I would look to possibly short those or even take out a few put options on stocks like that as a hedge against lower oil prices over the next few months. Ultimately, though, I would be looking to buy some of the higher quality oil services names in any dip that we'll probably see in the first quarter of next year.